There are two schools of thought when it comes to investing. There's technical analysis, which is just looking at stock charts and moving averages and maybe candlestick charting. And then there's fundamental analysis, which really just looks at a company's balance sheet. Many people ask, well, which one's better to use? Overall, the best thing, which always wins out in the end, is fundamentals. So if you want to become a successful investor, you have to know how to read company balance sheets. Now, I use kind of a hybrid in both. I use technical analysis, but not the way everyone else uses technical analysis. Most people will look at short-term trends, try to do day trades or momentum trades, look at moving averages, stochastics. All that stuff I'm here to tell you right now is total nonsense. It doesn't work. It may work on one or two trades in the short term, but to have long-term sustainable results with the least amount of risk, it's all about fundamentals. You have to understand how the company makes money, what kind of business it's in. Is it a sustainable business model? Does it pay out dividends? Do dividends continually get increased in the future? When I say I use a hybrid of both, I basically look at the chart as a confirmation as to what the fundamentals have done in the past. Because usually what the fundamentals have done in the past, meaning if a company has 30 or 40% return on equity, 40% profit margins, upward marching earnings per share each year over the past 20 years, usually that means that company is probably going to end up doing that same performance in the future. Why? Because if a company is posting such good financials like say a 40% return on equity or profit margins like say Coca-Cola does, sure enough, they're going to end up continuing that in the future. They have a product that people like. They have name brand recognition. Look at this chart here of General Mills. Now, this is a simple case of a simple product like cereal, but it's an extremely sustainable business. People will continue to eat breakfast in the morning, and they will continually buy cereal and cereal bars and all other products from General Mills. Now, General Mills, you could see has increased over 100 times without dividends over the past 30 years. With dividends, it's probably almost 200 times. You could even see the 1987 crash is extremely insignificant. And that should tell you that, people that look at technicals on like a monthly or yearly basis, they would be looking around the 1987 crash, say, all right, get out of the stock, sell it. But as you've seen, even if you did sell General Mills before the 1987 crash, look how insignificant that is. Look at all the money you left on the table by then not investing in General Mills because you were looking at some useless technical indicator. And what I mean by fundamentals is the future profitability of the company. And now you'll see here, General Mills, they recently bought Annie's. It was actually a publicly listed stock. I owned it for a little, and then I sold it. And I'm kicking myself in the butt right now. But Annie's makes those organic snack treats. You'll see them sold in Target. But this whole organic thing is getting huge, and all these companies know it. They've been buying up organic juices and organic snack companies for a long time now. They pretty much own the organic market, all these big multinationals. So how I use charts and how you should use charts is whenever you look at a stock, put it on the 30-year stock chart. You could go to Yahoo. I'll show you how to do that later to get a 30-year stock chart or all the data available, whatever they have. And you want to see a rising stock price just like General Mills, just like this. Because when you see this, if you have any company that you want to invest in, make sure it's making this pattern, a continually rising stock chart in a tight pattern. It's not all over the place. What this means is that the company basically has a monopoly on what it does. And I could pretty much guarantee you that any stock you're interested in investing in, if you just do this one test, put it on a long-term stock chart like this, and if the chart looks like this, all you really have to do then is just investigate the company, look at some Simple fundamentals. I'll show you how to do that just to make sure everything works out. See what type of business it's in. It should be a simple business. It should not be this crazy tech-related or biotech-related company. But the thing is, a biotech company will never have a chart like this. Maybe one out of 500 biotechs. Maybe you look at Genentech or something, or Celgene. I mean, one or two, but none of them have even been around for 30 years. So when you look at stock charts like General Mills, and it looks like this is where you could weave the fundamentals and the technical aspects together. And this will make you a much better investor if you do this. Any other these stocks that a lot of these people recommend from Hot Tips, I do this simple test. I mean, even before even looking up what the company does, if the stock chart looks terrible, it's all over the place and it's from high, low, boom, bust, you're not dealing with a solid, sustainable company, and you don't even have to investigate it anymore. You just look at the chart, and if it doesn't look like this, you don't even have to investigate it anymore. So again, fundamentals and technicals, a hybrid of both. The technicals is just a short, maybe use it for just a quick look over in the beginning, and if it passes that test, then you go into using the fundamental analysis, and then we'll go into the fundamental analysis much more. But definitely do this test when it comes to technicals. If all the charts look like this, and all the charts I recommend in this newsletter, all of the stocks you'll see, they all have a similar rising chart, just like General Mills. Maybe a little more volatile here and there, may have a little, more corrections, but they all have this same dynamic. And if you get this one point, you will be so much better investor in the future, and you'll learn to take these companies and then just know that when they pull back, you could initiate buys on them, and you pretty much will make money in the future. So we're going to talk about more of the fundamental aspects of investing now. You'll see more stock charts, and you'll start to get a feel of what type of companies you should be investing in and what type of companies you should stay away from. I'm going to have a section later on in another part of this newsletter talking about short selling, and you'll see that all the short selling candidates, they don't have charts like this, and they don't even pay dividends. So you'll see the different characteristics as you advance in this course, and it will make you a much better investing. And now we'll get more into fundamentals, what you should look at on a company balance sheet, and how to go about investigating a company and where to look, the websites, and we're going to get into that now. So now we'll talk about some ways in which you could check a company's financials. You'll always hear me talking about how the first thing you should do is make sure a company is in fact making money, turning a profit. But you may want to know, well, where do I find all of this information? Sometimes I go to websites and it's just a whole bunch of stuff. I don't really understand it. I don't know where to look. So I'll show you that now here, the best places to look. And these are free sites. A lot of sites now have, paid for services. So it's very hard to get like a 10-year earnings history. I even used to get it on msn.money.com. And their 10-year history stuff is gone. I can't find it anymore. I tried looking on the website all over, and I can't. But I found another website. Many of you may know about it, many of you may not. But a website, gurufocus.com. It's a pretty good website. It's a little crude looking. It looks like it's from back in the 1990s. Most of these financial websites, they're just not designed correctly. There's just so much stuff going on, ads all over the place. It gets a little ridiculous. But anyway, gurufocus.com does the job. So you go to the main screen, the front page, and you'll see a place where you could enter a ticker symbol. So for this example, I'll just enter a SAM for Boston Beer Company. That's the ticker symbol. And then once you go to it, you'll see a little tab that says 10-year financials. So you click that, and it brings you to the next screen, which shows you the 10-year history of a lot of different metrics. So now this is a good website where you could see the 10-year earnings history, and they have earnings per share, and they have diluted, which is good. That shows you diluted basically just means it takes into account the dilutive effect of stock options. So if a company is screwing around with a lot of stock options, and it just gives you the diluted value, so you could value the company based on the diluted number, which is usually the best thing to do. So you'll see here that the Boston Beer Company, it goes from December 04, so the year ending December 04, and then it goes up to December 13. And then it just starts quarterly, so don't really look at that. That's just for maybe the last couple quarters throughout the year. It'll show like June 2013, September 2013, December 2013. I don't even look at that. I just look at the yearly values from 04 to 13. And you'll see that the company is always making money out of all these years. There's nothing in red. So when it's in red, that means it's negative. And when it's negative, the earnings per share, that means the company's basically losing money. So you'll see here that basically nothing is red, except maybe a free cash flow per share, which is that's different. That changes due sometimes to acquisitions. They do buyouts. Maybe they build different factories or investing activities. So don't worry about the cash flow per share. That's just a per share number. Do not worry about that. But when you look at earnings per share, you'll see that in December 04, it made 86 cents a share. And then you go all the way to the year ending December 13, and it's making $5.18 per share. Remember, this is per share. So however many shares outstanding there are, you basically just divide the shares outstanding divided by the earnings, and that's how you'll get that per share number. So the per share number doesn't really mean anything. I mean, the amount of shares outstanding, that's basically the capital base of the company. That's really all. I mean, so you could have more. Some companies have more shares outstanding. Some companies have less. It's just, how old the company is. It doesn't really mean much. What matters in the end is the per share. And that's what they report to you. So you'll see on this balance sheet that right away, look at the earnings per share marching upward. So we'll start with 04. It's 86 cents a share, then $1.07, $1.27, $1.53. Then there was, in 2008, it dropped down to 56. But this is what I'm talking about. It's an aberration. You see how it jumps right back to $2.17 per share? That means this is a very strong business. And you could see it just keeps going upward. So the trick is to find companies like Boston Beer Company, and then you wait until something happens to their earnings, whether it be a recession. That's why it's great to buy in recessions, because when the economy gets better and recovers, these type of companies with strong balance sheets are always the first out of the gate. And the reason is a lot of times they do acquisitions and they end up buying out their weaker competitors. So they end up emerging out of recessions actually much stronger than when they came in before the recession. So even though the stock price is actually a lot cheaper and the valuation is cheaper, the value of the company is usually a lot higher than before the recession. And that's why you'll see companies go on to make even higher highs. They surpass their old highs because they're a much stronger company. So the earnings per share on this is very solid. And this is what you would do. Any company you want to investigate, come here, get a 10-year earnings history. You may have another website you go to that has 10-year financials. But this is the first step you would do. Then you would want to say, all right, well, what is the return on equity? And the return on equity is basically think of it like the equity in your house. So you put a 20% down payment, say, on your house. So if your house price goes up 5%, you don't make a 5% return. You actually make a 5% on top of the whole asset base, which is, say you bought a house for just let's just use an easy number, $1 million. Well, 5% of $1 million is $50,000. But, you don't own the house outright. You didn't buy it for $1 million. Say you put $250,000 down, or say you put $200,000 down. So now, $50,000 gain on your $200,000 down payment, that's a 25% return now. That's not a 5% return. So think of return on equity that way. It's how's the management doing with investing the money. So just like you were investing the money to buy a house, that would be the capital that you invested on the down payment on a house. And you basically got that 5% return was actually a 25% return. So that's return on equity. Very basic way. And when you see return on equity above 15%, that usually means it's a good company. Warren Buffett once said, I think he had a rule that he doesn't invest in companies unless the return on equity is above 12%. So you'll see here, return on equity for Boston Beer Company, just around 17, 18, 20, and then towards December 9, 2010, 2011, it's getting up into the 30, 40s. And that's when Sam Adams beer is starting to get much more popular. It's growing more, and this is why you see this increasing return on equity, which is excellent. Return on assets, very good. It's kind of, to a point, strips out the debt, because you could raise your return on equity numbers by increasing your debt for the company. Return on assets is actually more of a true value. When you see return on assets around 20, I mean, that's phenomenal. I mean, you see that's excellent. So again, more things. This is what reading the company balance sheet is all about. And we'll go over even more metrics we'll start to talk about. And there's so many things that you can get out of the balance sheet, and it will make you such a better investor. Margins are something very simple, but it confuses a lot of people because there are different types of margins. And as we see on this balance sheet, you'll see gross margin percentage, operating margin, and net margin. And there's a difference. So everyone needs to understand basically what the gross margin is. The gross margin is basically just the price of a good minus the cost of goods sold. I mean, that's just generally, you'll get your basic gross margin pretty much before any expenses like wages or anything like that. It's just a basic number. So it doesn't really tell you much. It does tell you to a point what your profit is on, say, each product you're selling. But if you don't take into effect wages and raw materials, it really means nothing. So you have to look further. So now operating margin, if we look at that, that, of course, is going to be a much smaller percentage number. Why? Because operating margin is basically, what do you have left over in revenue after paying wages and raw materials? That's what operating margins are. Okay? So, like, say if McDonald's was selling a bunch of hamburgers and they didn't have anybody working for them, the hamburgers just miraculously sold themselves. Well, then their operating margin would be really high. It would actually be close to their gross margin. But that's not the case. The case is that they have to pay workers, whether it be minimum wage or not. The bottom line is that they're still paying workers, and they're still paying raw material costs, whether it be the electricity in the actual McDonald's buildings, and that's all part of cost of goods sold. So that comes out to that's your operating margin. Now, your net margin is basically all the revenue remaining after you pay operating expenses like, say, like taxes. So that's the net margin. The bottom line after all of your expenses, that's going to be the net margin. So just think of these three margins as just different steps. The gross margin is before a lot of the expenses. The operating margin includes some of them. And the net margin basically just includes all of them. I mean, if you just think of it that way, it's a very simple way to go about thinking about this. You don't have to get crazy into, calculating everything yourself and finding out, how much, what exactly are wages, how many workers. I mean, it tells you right here on the balance sheets. These are from SEC documents, and you could double check them against the 10K and stuff like that. But that's all you have to do. It's not hard. It's actually very simple in the end when you just look at the hard numbers that are already here for you. And this is the beauty of the internet. All of this information is just handed to you. And there's really not much work you have to do when investigating a company. Of course, we'll talk about later on about you have to read the annual report, and it's pretty much a must, listen to the conference call. You'll learn a lot about the business. But when you're looking over the balance sheet like this stuff, the margins, not really that difficult. If you understand it and somebody explains it to you in a very simple manner, it'll stick with you forever. Now, the net margins on Boston Beer Company are still good going into 2009, 2010, 2011. They're pretty much around the 10, 11, 12 area. Now, if you look at Anheuser-Busch, ticker symbol BUD, B-U-D, they actually have much higher net margins than Boston Beer Company. Maybe because Boston Beer Company sells, Sam Adams, and it's more of a premium beer. So they don't have much of a profit margin with premium because there's only so much you could sell beer for. You get to a certain price point, most people really aren't going to pay so much for a glass of beer or for a case of beer at the supermarket. There's only so much they'll spend. And Sam Adams is a more premium product, but you could see their net margins aren't as much as Anheuser-Busch. Anheuser-Busch is actually in the 15 to 20 range, and I think for 2013 it was above 30. It was incredible, but I think that was an aberration. But yeah, these net margins mean a lot, and it has to do with investors look at this to assign a valuation on a company. This all has to do with what PE multiple will investors assign a company, and we'll talk about PE ratios later. And some companies will trade at a higher multiple. And multiple just means PE ratio. So instead of saying higher PE ratio, they'll just say higher multiple. So if a stock is trading at a higher multiple, they're bidding up that stock more. And if it's trading at a higher multiple for a long time, that means that the company is pretty much valued higher than a company trading at a lower multiple. So, and then we'll get into looking at cyclical companies, and sometimes a low multiple is actually a value trap, because it means their earnings are extremely high for that period. So when you just take PE, price divided by earnings, well, if the earnings are high, that's the denominator, and it's going to make the PE ratio lower. But that could be a value trap. We're going to get into all of that with PE ratios, and you'll learn about that and some simple things to stay away from. But right now, if you look at the margins in this way, the gross margins, they're important, but they're not the most important. I really like looking at the net margin, and I also like looking at the operating margin. The operating margin, if you see the operating margin really go down a lot from the gross margin, which you actually do see that happen with Sam Adams here, with Boston Beer Company, in the earlier years, like 04, 05, 06, you'll see it had almost 60% gross margins, and then it goes down to 10. So that's telling you that their operating expenses are actually very high. But that could be as the company, the marketing expenses maybe are very heavy. They're getting the company off the ground to more and more people. They're giving maybe good incentives for supermarkets and maybe bar owners to sell the beer, giving them better terms. So this is where you could see this in the balance sheet, and it's very easy. And then you look at the margins, stabilizing out later on years, and maybe they start growing, and you want to see them stabilizing. And you could see the net margin growing with Boston Beer Company as the years go. Now, every year it's not going to grow perfectly. There may be some years, where it goes down. Maybe they have, much more, like I said, higher marketing expenses. But this is all stuff you need to look at that could give you a visual picture. And like I said, once you get done with this video newsletter, you'll have such a better understanding in a simple format. You don't have to go to business school. I mean, even Warren Buffett himself said, all these MBAs, they really don't know what they're doing. He's like, because of them, it's because I make money. You have to think in simplistic terms, because remember, this is business. That's it. There's a company behind this, and what is it? It's a beer company. I mean, how hard is it to understand beer? You sell beer and people drink it, and then they buy it again. That's it. If you think about it in a very smart, basic manner, and also a calculated manner like this when we're looking at the balance sheet, you'll have a much more fundamental, easier understanding of investing, and it'll be much more enjoyable. You don't have to get carried away with all this craziness. Like that's why I don't invest in banks. There's so many off-balance sheet and all these derivatives and all these numbers, stuff that even the CEOs do not even understand. It's better to invest in stuff like this, beer, cigarettes. We'll talk about that later. Simple things is what the richest people in the world invest in. They don't invest in complicated stuff. The more complicated something gets, the more often you're going to lose money. All right, and we'll talk earlier. I'll show you a stock chart, later on about that GT Advanced Technologies. It lost like 92% in one day. They make those sapphire crystals for Apple, and then something happened with the contract for Apple, where they didn't get it, and Apple didn't use them anymore, and it just got killed, the stock. So You don't need to invest those sapphire crystals and all this nonsense. You don't need to invest in that. Candy, beer, cigarettes, toothpaste, simple railroads. I mean, we're going to show you later on. I'm going to profile. You're going to see a lot of stock charts later on. And you'll start to see a basic theme of how this investing stuff all ties in together, because it's really not that hard. But reading the balance sheet, learning the balance sheet like this is the first step to becoming a much more informed investor. We'll now discuss PE ratios, which is a very interesting topic and can actually get very in-depth. And I'll try to explain it here in a simple manner so everybody can understand. Now, all the PE ratio is the P, which is the price, and the E, which is the earnings per share for the previous year. So that would be the PE ratio or the trailing PE. And if you use the earnings for, say in the future, they would call that the forward PE ratio. I mean, it just matters. That's all that means when you hear trailing PE and forward PE. So you just take the stock price. So if something's $100 a share, and then the earnings, if it earned $2 per share for the year. So 100 divided by 2 would be 50. So the PE ratio would be 50. So now, what does the PE ratio measure? Well, it measures a lot of things, and I'll try to explain all of them. First of all, the PE ratio, what it could tell you that a $100 stock price on a certain company, that company could be a lot cheaper than a $1 stock price. So if you have a company trading at $100 per share, it could be cheaper than a company trading at $1 per share. And people may be asking, well, how could this be so? And the reason is because the stock price means absolutely nothing. So when you hear people talking about, such and such stock only trades at, it's only $5 per share, I could get so many shares, it's cheap. It means nothing. The stock price actually should be totally irrelevant. People should really never look at a stock price. You have to take that stock price and divide it by the current earnings. So how much is that stock worth in relation to how much the company is making? So you could have a $2 stock price and think it's cheap, but if the company's not making anything, if it's actually losing money, or if it's earning 10 cents a share, it's not making any money for shareholders and for the stockholders, the owners of the company. Yet you could get a company like Berkshire Hathaway trading at $100 and something thousand per share. People may think that's expensive, but the company earns a boatload of money and reinvests the money, and the stock price continues to go higher. So a stock price in itself means absolutely nothing. The first test you could see when talking to somebody about investing, whether they're an amateur investor, is when you start talking about stocks and they start telling you that such and such stock is only $3 per share. That's cheap, and that's usually the mark of an amateur investor. They'll never say it's trading at 15 times earnings, and that's when you hear people say that, they're just saying the PE ratio. So if the PE ratio is 20, they'll say it's trading at 20 times earnings, or it has a multiple of 20. That's all that means. When people start talking like that, maybe you could start saying that, all right, this person probably knows a little bit more about investing and valuing companies than the rank amateur on the street who really doesn't know what he's talking about. The guy who's recommending Sirius satellite radio, because Howard Stern got announced to be on it many years ago. And, the guy doesn't have a damn clue about what's going on. He just says, yeah, it's trading at such and such per share. But the company's garbage. It's losing money. It's running losses, has high debt. So that's the PE ratio for one aspect of it, just to basically give you an overall multiple, pretty much a valuation. And you could compare certain stocks to one another. And you could think if this is trading at 20 times earnings and this is trading at 10 times earnings, or in other words, this has a PE ratio of 20 and this has a PE ratio of 10, then the 110 is maybe cheaper. But that's not exactly how it works. If it worked like that, everybody would be rich. So it's not like that. First of all, the reason it's not like that is when you compare stocks, you have to make sure you compare stocks in the same industry. A PE ratio of a beverage company in the beverage industry will be a lot different than a PE ratio in the banking industry. Banking stocks you have to compare a banking stock to a banking stock. You have to compare a tobacco company to a tobacco company. You can't compare apples to oranges because the PE ratio is useless. Because industry PE ratios, it basically goes by industry, what the PE ratios, what these companies trade at and how they're valued. It makes no sense to value Apple Computer against Philip Morris. It's useless. And that's why some people get hung up on PE ratios, but they're not comparing apples to apples. They end up comparing apples to oranges, and they get all confused about what they should use the PE ratio for. Another topic with the PE ratio, how it should be used. Sometimes companies trade at a higher PE ratio because they are actually a better company. So a company may be bid up more by investors. And you could look at individual companies, and I'm trying to give examples. It's hard to think of an example, but say maybe Coke and Pepsi. Coke over the history has generally been a better stock than Pepsi, and it's always traded at a slightly higher PE ratio than Pepsi. Coke's return on equity is better than Pepsi. Investors value Coke a little bit better. Although Coke and Pepsi in the past few years has been making some, pretty good management moves, and Pepsi's been a pretty good investment. Coke just hasn't been the best investment because it got so overvalued in the 1990s. So it's still a great company though now, and it came into a much better valuation over the past few years. I've been buying Coke over the past 4 years, continually adding to my position. But Coke is a solid stock, but that's one way a PE ratio can be used, is by looking at how a company's growth is valued. Usually people will say never pay up more than 2 times growth for a company. What does that mean? 2 times growth just means that if a company is growing at 15% per year, you shouldn't pay more than 30 times earnings, or you shouldn't pay more than a 30 PE ratio for that stock. So if a stock is growing at, say, 20% per year and the PE ratio is 40, that should kind of be the limit. And that's how people get into valuation techniques using PE ratios. It could kind of tell you if a stock is very overvalued. So if a stock is only, if it's only growing at 10%, but the PE ratio is 35, you kind of might want to stay away from it, because there'll probably be a correction coming soon, and the stock will probably go down 20 or 30%. And when you use all these metrics, this is how you become a much better and more informed investor. And this is what we mean by, reading the balance sheet. Every time I say, you got to look at the financials, look at the balance sheet, this is the kind of stuff I'm talking about. Now, where do we find all this information? Well, the best website to use for this kind of stuff, for price ratios, and to actually get a visual picture of these ratios, is go to money.msn.com. Now, they changed up the website recently. They used to give you the 10-year history in kind of like a written format, but now they give it to you in kind of a visual format. It's actually pretty cool. I kind of like it. So all you do is go to money.msn.com, put in any ticker symbol. So for this example you're seeing on the screen right now, I just use Fastenal, just a basic, really good company, just to give you a visual aspect of what's going on. I don't know if you have to log in with a Hotmail account to see some of these metrics of the 10-year history. So I'm logged in here with my account, so you guys might have to have a Hotmail address. If you don't, it might not show you the 10-year history. Maybe it shows you 3 years. I don't know. I've never looked at this website not logged on, so I don't know. So just look into that. But if not, just get a Hotmail account. It probably takes 2 seconds. But anyway, what you're looking at here is you put down into the ticker symbol Fastenal, F-A-S-T, whatever one you want. Use whatever you want. And scroll down. Scroll all the way down, you'll see this little grid where it says fundamentals. And click on price ratios. And when you click on price ratios, it just gives you a visual history over the past 10 years of the PE ratio, the average PE, which is exactly what we're looking for the year. That's what you want. And you can see it gives you a nice visual line. You'll see here Fastenal, it was around 36, and it kind of went down during the recession. Then it popped back up. It just shows you how investors are valuing the company. Price to sales, I don't really look at too much. It's a little quirky. It doesn't really work too much. Price to fails could be, investors could be using it, then they don't, then they do. I don't use it. Same thing with price to book. I don't really look at it too much. Price to book value could be more, better for the financial or the banking sector. Not really for, industrial companies too much. But you see the average PE, and it gives you the average of what it is. So now, if that PE, if you're looking at a solid company with stable earnings, like we've talked about, stable return on equity, and this thing starts dipping, it starts becoming more of a value to an investor. It becomes more of a value investment. It's getting cheaper in value. So it becomes something to look at, okay? Now, if we click on management effectiveness, this gives us the 10-year history of the return on equity. I mean, this is beautiful. You could see a visual picture over 10 years what the return on equity is. And you'll start to see a picture of, okay, how do investors really value this company on average? So if you see that the return on equity here is between the averages between 18 and around 22 or 23, you could start saying to yourself, okay, if it ever dips below 18, the return on equity, well, first of all, I want to find out why. And if it's really nothing to worry about, I could maybe buy. Maybe it's just because the stock market's correcting and the investors are valuing the company bad, and it's a whole range of reasons. So now if you also scroll further down, you'll see something that says ownership. And now this gives you the top mutual funds that own this stock. And you can see with Fastenal, the Sequoia Fund, which is a great mutual fund, one of the best mutual funds out there, actually has Fastenal as one of its biggest holdings, and it owns over 2% of this company. So the Sequoia Fund, you could start seeing that when other mutual funds are holding the stock that you're looking at, this is a good sign. And you'll see on the left-hand side, it says institutional ownership. That means 88% of the stock is owned by institutions like pension funds, bank funds, hedge funds. That's good. They have a lot of faith in this company. And if you look at 5% insider ownership right below, you're looking at 9%, 5% insider ownership. This is pretty good. You want to see the insiders own a pretty big chunk of the company because they make their money when the stock price goes up. If you see insider ownership pretty much next to nothing, like 0.05%, this is a little something to worry about because the best interests of the stockholders really aren't, management doesn't have the interests of the stockholders really at heart. They may start just pillaging the company. And you'll see that with a lot of these big S&P 500 companies. These people get on the board and the board members just pillage the company and clean it dry. And they just screw the shareholders. It's really pathetic what goes on at a lot of these companies. So many of these board members are cronies, and it's really bad. So when you see a high insider ownership, that's a very, very good sign. So the PE ratio, again, what you're looking for is you want to know the historic PE ratio, where it usually trades at. And you kind of want to buy when the PE ratio is lower. Now, this doesn't work with cyclicals, which I'll talk about right now. A cyclical is a company like a steel company, or even like a gypsum wallboard company like USG Corporation, which is very housing related and very construction related, and the construction industry is very cyclical. What happens is when you take, again, the PE ratio, price divided by earnings, what happens is with cyclical stocks, their best earnings are usually at the end of the cycle. So when they report these like blowout earnings, it's usually the end because the economy is so hot. And you saw this with a lot of housing related companies. So when the earnings is going to get so inflated, when you divide the P divided by the earnings, what you're gonna get a low PE ratio. So what's going to happen is that it's a value trap. It's gonna look like the company's on sale. Like, wow, this has a low PE ratio, but it's not. It's just because there's blowout earnings and the PE ratio looks low, but it's really not. Once those earnings crash, then the PE ratio is going to skyrocket. You actually saw the PE ratio of the S&P 500 skyrocket during the 2008-2009 collapse. The PE ratio, I think, went up to like 70 or 80 or something like that, just for a short bit. But you can't, when things are not normal, when the E gets distorted in the PE ratio, when the earnings get distorted, you can't really use PE ratios. You could only use PE ratios on companies that have very stable earnings. And then what happens is when you get like an earnings collapse and the PE ratio doesn't really work anymore, that's when you know you want to buy the stock. You're not looking to buy when the PE ratio is just really just a little below average. You're looking for a PE ratio to kind of get out of whack because the earnings. But you got to know the reason. It's not always because of the earnings. It's because of the price. The stock price has went too high. The stock price went too far ahead of its earnings, giving it a high PE ratio. That's when you know you could use the PE ratio. But when the E, the denominator, gets out of whack, well, then you got to look at other factors. And with cyclical stocks, like I said, be careful because a lot of these cyclical stocks, these steel companies, they have low PE ratios in like the single digits, but they're actually the most expensive in history and you will lose a lot of money. I mean, this happened exactly with USG Corporation. This thing was trading at like $90 or $100 a share, and people were recommending it right before the housing bubble burst. And they said, look, it has a PE ratio of 7. This thing can't go any lower. And what happened? It crashed to about $5 a share. So don't even be careful with cyclicals. Cyclicals is a whole different way of valuing. You have to look at industry metrics. So for instance, if you're investing in the housing market, you want to look at building permits. You want to wait for building permits to pretty much collapse, and then that's when you want to buy the housing related stocks, because then building permits are going to start going up over the next decade. You don't really want to look at PE ratios too much. The industry metrics will help you the best. So even a company like Fastenal, PE ratios help, but I want to look more about industrial production numbers. You want to start adding everything to it, and we'll start talking about on the economics section of this newsletter. I'll go into kind of what economic metrics to look at and if they really do help or not. I have all charts for that. You guys will see the economic part of this newsletter is very good. You guys are going to enjoy it a lot. You'll learn a lot. But PE ratios, this was pretty much a crash course in PE ratios, and I think I explained a lot of how you should use PE ratios. You'll probably have to rewatch this section a bunch of times and take it very slow, because it takes a long time to get this under your fingers. I've about 16 years of investing, doing this for hours upon hours each day, just living and breathing company balance sheets, investing, conference calls, and reading industry books and trade journals. And this is why I want to pass on this knowledge to you guys in more of an easy to listen to format with pictures and charts, because I think that's the best way to learn. And when the learning experience is much easier, where you could listen to this on a train ride to work, or in your car, or just sitting on your couch at night, it's a very easy way to learn. You retain the information much better. So hopefully this section with the main parts of the balance sheet I showed you, return on equity, earnings per share. You also want to look at debt equity ratios. But what I covered here is just, this is really all you need. You don't have to get into all this craziness. The companies I invest in that I recommend here, they don't have a problem with looking at receivables. Are the receivables, the inventory turnover? Oh my God, are these company products sitting on a shelf and they're obsolete, like at a tech company? So if they don't sell them, within 6 months they're obsolete, and now the stated value on their books is actually a lot lower. So that happens with these tech companies or software companies, whatever. I don't invest in those companies, and I don't recommend them here. So you'll see all that stuff is useless. You don't need it. We talk about return on equity, earnings per share, and the basics. And you're going to see that investing becomes so much enjoyable when you stick to the basics and you stick to basic companies that make shareholders wealthy and have a history of dividend increases. So all of these balance sheet metrics mean nothing if at the end of the day we do not take debt into account. And debt is most things, it's the most important thing that usually brings down a company when it gets into trouble. You saw in the 2008 2009 crisis, what industries and companies had the biggest problems. It was the banking and finance industry because they had the most debt. They had toxic assets that were leveraged many times over. So they have no capital base. So what happens is if you get a 5% decline in an asset, it's so leveraged that it'll pretty much wipe out all of the equity. And that's what happened. The finance industry pretty much thought this notion that housing never goes down. So they leveraged up so much on that one asset. People did this during the Great Depression, not with houses, but with stocks. People margined stocks 9 to 1. So if they had, say, $10,000 invested in the market, or say they had $10,000 cash, they pretty much borrowed $90,000. So then if the stock market went down, 10%, they'd be pretty much almost wiped out. And when you get into that type of thinking that things never go down and you leverage up, and when companies leverage up, thinking that times will just stay humming along and be great forever, well, that's when companies get into trouble. Now, what do I use to look and see if a company's debt is a little out of control? Well, first I look at a debt equity ratio. The debt equity ratio you could find pretty much on any major financial website. Go to Yahoo. But you could find the debt equity ratio, and usually, of course, different industries are going to have higher capital intensive industries, like say autos are going to have a higher debt equity ratio. And that's why I just stay away from those industries. I would never invest in such a capital intensive industry. GM's debt equity ratio is near 1. Anything over 1.5, 2, that's starting to get into trouble. And I don't like investing in companies like that. If you look at a company like Church and Dwight, its debt equity ratio is 0.39. Fastenal, which is a company that has no long-term debt, it has a 0.05 debt equity ratio. I mean, that's excellent. This is the type of company that when there's problems in the economy, whether it be global economy or just the economy at home, when other companies get into trouble, Fastenal is going to be able to buy problem companies on the cheap. That's what will happen. And that's why during recessions, strong companies usually always get stronger, especially the companies with no debt. Bank of America has a debt equity ratio of right now, I think it's almost 1.2. It's pretty high. So if there's so many companies out there with lower debt equity ratios, why would you invest in something with an extremely high debt equity ratio? Now, if a company has higher debt, but it's an extremely stable company, has extremely stable cash, maybe sells a consumer product, that's a little bit different. You could value it differently. But something like a bank, this is why I just do not like the financial sector. There's too many what ifs in the financial industry, and I just stay away from it. I do not like owning companies of things I do not know. Like I said earlier, most CEOs of these banking institutions, they don't even know what's on their own books. So if they don't really know what's on their balance sheets, why should you invest in them? It's crazy. So debt is something that companies, and debt's not bad, but companies raise debt different ways. They could issue bonds and notes and raise money from investor money. They could go to a lending institution and take out a loan. So just be careful for certain things with companies that take on debt. Now, certain companies you'll see take on debt, they'll actually do company buybacks. They'll buy back their own stock with debt. I do not like that. Unless the company has an extremely high cash flow business that's very stable, something like a Philip Morris International, a cigarette company, or maybe an alcohol company, where the cash flows are really stable, that's maybe okay. Any other industry, it's a big red flag. When you see a company buying back stock with debt, definitely a no-no. I do not like that. Many times it blows up in their face. And look, all buying stock is taking the cash, and companies don't really have much to do with that cash. They can't really reinvest it in the business. They don't really know what to do with it. They have so much. So what they'll do is they'll just buy back stock, meaning they'll buy their own shares in the open market, and it destroys the outstanding shares. So the amount of outstanding shares go lower. So when you calculate earnings per share, you take the earnings divided by the shares outstanding, you'll get a higher EPS number with a lower amount of shares outstanding. So just think of it this way. When a company buys back shares, they're making your interest in the company much bigger. Your slice of the pie that you own is bigger. So when they report earnings, they'll report a higher earnings per share number. So this is why companies, like I said, again, I keep using these cigarette companies as an example. They may not be growing that much, but they have so much cash that they keep buying back shares. And that's why you'll see their earnings numbers keep rising. Many people will say, well, how are these companies, continuing to make money? People, they're smoking a lot less. No one's smoking anymore, really. And how are they growing their earnings? Well, number one is that's how. They're buying back shares. And number two, just because smoking rates are going down doesn't mean the total number of smokers are going down. Population is rising. So you could have a country where the percentage of people smoking is less, but actually more people are smoking because it takes into effect the population. Also, the emerging markets, cigarettes is still pretty much a growth industry in a lot of these emerging markets like Indonesia, the Philippines, the North African market. So just because it's slowing down in the United States does not mean that these companies can't continue to pump out profits. But anyway, I don't want to get off the subject of debt. I'm just showing you how if companies buy back shares with debt, be careful. But look at debt equity ratios. Make sure that the company, another quick test I use is the amount of assets a company has. It's just asset and liabilities. If you see the liabilities are much more than the assets, stay away from it. I mean, that's all I do. It's just, if you use these simple tests when looking at a company balance sheet, it becomes really easy. And usually a company that has excellent return on equity, good long-term track record of rising earnings per share in a stable industry, usually their debt load is also going to be low or manageable. And there is no one answer. I can't give everybody, look for this exact debt, ratio, because every company and industry is different, and valuation is also more of an art. If there was one single way to value a company, well, then there would just be some stock screener, and you could just input everything you're looking for, and voila, whatever stocks come up, you'll just invest in those stocks and then get rich in 20 years. But investing's not like that. Investing is an art, and that's why even doing many of these newsletters, and just, you'll read investment books, you'll talk to many investment professionals. I've spoke to a few mutual fund managers, and sometimes you'll walk away after talking with them kind of like you really didn't learn much. And it's because investing is an art. There is no single book or single way to do things. It's all about investing your money in a company that's making money. So if the company's turning a profit and you own shares in that company, you're going to get a piece of that profit. Now, if they're taking most of that profit they're making and using it to pay off debt because they have such a high debt load, well, that's going to be less profit for you, the shareholder. Just look at in your own personal situation. You could have a great income, a great job, okay? But all that cash that comes into you each week isn't yours. You may have an extremely high mortgage on your home, or you may have a huge car payment. So all that cash that you're getting is going right out the window right when you get it. So your balance sheet is not strong, okay? So it's an art. It's an art form, but if you could follow those simple metrics, maybe a debt equity ratio below 1, make sure the assets are more than the liabilities, of course. Look at the cash flow statement. Just make sure that the company's earning a profit, that there's cash coming into the company. It's positive cash flow. That's it. Many companies don't even have positive cash flow. They just continually running in the red. And when that happens, the debt continues to build up. So debt is a very important thing. Almost all the companies that you're going to see me recommend throughout this video newsletter are going to be companies with manageable or low debt. I will not show you companies that are in the red with extremely high debt loads. Now, also, just because I showcase a company on this newsletter doesn't mean you go out and buy it. All right? You have to still do your own research, okay? If you see it here, don't run out and start buying off the stocks. This is pretty much I'm showing you what I buy and what I own. What you do is your own personal situation. So I really want to stress that because everybody has to know this. As much as this is a video newsletter trying to teach you the fundamentals of investing, I'm not a certified financial planner where I tell you invest in this stock and you go do it. You know, financial planners have a terrible track record, and I'm happy to say I'm not a certified financial planner. Most of these people have been taught all of the wrong stuff. Look what they did to people's portfolio during the 08 and 09 collapse. I mean, so many of these financial planners just got fired. I mean, their track record is horrible. So anyone that tells you they're a financial planner or a CFA or all this nonsense, run as fast as you can. Investing is not hard. It's simple. It's about buying a good business, a business that makes money. And if you just keep it simple and stick to the metrics that I've shown you in this segment, from return on equity, the earnings per share, debt, sales, operating and net margins, things like that, that's all you really have to do. And that's if you stick with basic industries. If you're going to go off and invest in some, weird financial institutions, well, I can't help you there. I don't invest in those companies. I keep it simple. And if you keep it simple, you will be successful and have a great long-term track record. And like we discussed in the beginning, you have to be a super long-term investor. You can't buy these companies and trade them in 3 months or a year. These are companies that you see on this newsletter that should be held for 10, 20, 30 years or more, dividends reinvested, and try to just keep most of these companies pretty much forever.